Good afternoon and welcome to Biztech's Asian Midday Market Watch, powered by Rajhi Bank, Malaysia. Kelvin Wong, market strategist at CMC Markets, is our guest today. Kelvin, great to have you every Wednesday.
My pleasure, Brian. Good to see you again.
Now, before we get your insights, let's take a look at how markets across the region are performing. But first, we will take a look at crypto markets. Now, Bitcoin is at 20,326.9. It's down 2.13%. Ethereum is at 1,153.27. It's down 2.83%. Now, looking across the regional stock markets, we start with the SGX. The SGX is up 0.37%. The Bursa Malaysia is up 0.06%, but the rest of the region, it's looking pretty red. Shanghai is down 0.81%. The ASX All Ordinaries is down 0.95%. The Nikkei is down 1.2%. The Hang Seng is down 1.65%. And the Kospi is down 1.45%. Kelvin, what are the reasons for this negativity in the market today?
Okay, so if you look at it, one of the major negative feedback loop that causes kind of a more muted or downside movement in regional Asia stock market is due to the pretty much of I would say that lackluster performance seen in the overnight US stock market, where we start to see the two major stock indices fell off quite a bit. The SPX 500 dropped by 2%. Then the higher beta Nasdaq 100, which consists of the more tech and growth-oriented stocks, fell by a much lower number at a negative 3%.
Now, Kelvin, you've got some charts to show us to explain some of the issues behind the drop.
Yes. So maybe firstly, let me take you through, before showing the chart, is that the reason for the sell-off in the US stock market, the narrative was actually due to a very, very weak US consumer confidence number out from this US conference board. So you see the latest number for June actually fell again. We are now actually coming close to a number of more than 10-year low. So that actually kind of stoked the fears of stagflation back into the market. That means we talk about lower growth as well as higher persistence inflation numbers. So that gave a bit of scare on the market itself. But now the chart I want to share with you is over here is that there could be, there's this narrative that's building on the market. Possibly there's, hey, will this be a potential, yesterday's sell-off in the US stock market, will it be a prelude to actually see a steeper decline to break their 16 or 17 recent June lows? So there are actually some argument that goes against this narrative. That means, i.e., we could potentially see a continuation of last week's rebound. One of the factors I high is this inflation expectation numbers, which is this is the green line, the blue line and the orange line is actually the 5-year break-even inflation and 10-year break-even inflation. So in a nutshell, it's actually telling us, based on the US Treasury market, implied by US Treasury market, tradable, we call it financial instrument, what is the inflation expectation like in the next 5 and 10 years. So you could see that the next 5 and 10 years inflation number has been inching downwards pretty generally in progress since even last 2 weeks ago FOMC, and even since their March high level. So what it means that over here is that inflationary expectation future, in a forward-looking basis, has started to cool down. So that could actually mean that, hey, in the next FOMC meeting, perhaps in the month of September, the Fed may not actually hike so aggressively as being currently priced in the market. So that is actually a positive, I call it a catalyst for the market if you look at from a forward-looking expectation. Then the last one on share is actually also related to this inflation expectation. You know that as inflationary expectation keeps on going up, the Fed will be more hawkish. So that will actually translate into higher cost of funding, which is actually negative for a risk asset perspective. Why? Because a higher cost of funding will lead to what I call it higher investment cost for corporation to actually invest in their capital or to fund their businesses. So one way to look at it is in terms of tradable instrument will be this 10-year US Treasury yield. This will be like a benchmark for medium-term to long-term cost of funding, given that this is considered as a risk-free rate. So this is where we derive our, we call it a corporate rates or mortgage rates from, in a nutshell. Okay, so if you look at this 10-year US Treasury yield, since its high of 14th of June, we actually confluence with this key medium-term pivotal resistance zone 3.44% and 3.53%, it's been trading in a short-term down move. So what you could see right now is actually retracing a potential lower high consecutively, second lower high that we see, or even third lower high if you take the high of 14th of June. So what it means that over here is that the implication from a lower inflation rate expectation forward-looking has started to feedback into the US Treasury yield, indicating to us, hey, there will be a potential slowdown in cost of funding, which is also a kind of a positive catalyst as well. So now, do not forget over here is that in the last couple, in fact, the last 3 to 4 weeks, why the stock market actually fell quite badly is due to this inflationary scare that's being priced into the
Correct.
market. Yeah.
And so now the charts are telling us that that is moderated essentially.
Yes, so that's moderated. So from here, what we could see is that it could actually lead to the Fed, because Fed tend to be, they always say that, hey, we need to be data dependent. So if this number starts to fit into the real inflation data, which is the CPI, which tends to be much more lagging for the month of June, if we could start to see a slowdown, so that particular inflation moderation narrative will start to get being fit into the market, which is pretty positive. So lastly, right, let's take a look at the chart of the SPX after yesterday's sell-off. So this is a short-term chart, which is the 4-hour chart. So these are the important levels that I'm watching. So there's this key medium-term pivotal support that we set for this week, which is at 37.75. So let's say if this level could hold, we could actually potentially see another leg of rebound to actually test this near-term resistance at 39.80 in the first step.
Now, Kelvin, before we go, one last thing I've got to get your insights on is really around 2 figures that have come out this morning.
Yes.
One was retail sales numbers in Australia, which rose 0.9% in May compared to April, similar to the number from March and April. But also then South Korea consumer sentiment index falling, standing at 96.4% for June, down 6.2% from May's print. So those 2 numbers then are kind of conflicting. The Australian number seems to indicate that the Australian consumer sentiment remains strong. The Korean seems to be weaker. What are your thoughts on that?
Okay, so what I could say over here is that let's start from the Korea consumer confidence first. So Korea consumer confidence, right? If you look at it over here, is pretty much in line to consumer confidence number that's being seen across the globe. Like for example, the one that we see last night, which is the US conference about consumer confidence. So that is pretty much in line with the current global, we call it scenario right now, where consumers are pretty much pessimistic about their near-term future. Why? Because of this risk of higher inflation, and also there's this risk going about stagflation as well. It's about lower growth due to this lesser propensity to actually spend, or by this even themselves or even by corporation due to the higher cost of funding. So that could actually explain pretty much this Korea confidence number. Whereas on the other hand, right, talk about this Australia retail sales, which is coming pretty much in line or also within expectation. Our view this is more like a pretty much of a lagging indicator, because retail sales, right, tends to have a 1 to 2 month lag behind we call it because that is what customers spend in the last 2 to 3 months that's being fit into this number. So it's pretty much interesting to see further next we call it the numbers of June instead, to see how these retail numbers stand up. And do not forget that the RBA only just started to actually up their ante in terms of their interest rate hike cycle. That means previously they were not so hawkish comparatively. If you talk about 1 month ago versus 3 months ago. So I believe that the Australia retail numbers should potentially see a lower number for next month. Out next month, that means for the month of June number in July, when the data release again.
Kelvin, as always, thank you very much for your insights.
My pleasure, Brian.
We've been speaking to Kelvin Wong, market strategist at CMC Markets on Biztech's Asian Midday Market Watch, powered by Rajhi Bank Malaysia. I'm Brian Fernandez. This video and podcast will be on our website, www.biztech.asia, as well as Rajhi Bank's social media platforms. Thank you very much for tuning in.